Good morning, good afternoon. This video will be on top-down analysis, understanding how to do the top-down analysis. First and foremost, you must first understand that the higher time frames is more paramount to narrative. So every time you form a narrative or anytime you are trying to understand where price is likely to draw to next in a longer time frame, it's best to focus more on the higher time frames, which is the monthly, the weekly, and the daily time frame. All right. Another reason for this is because this is the time frames that the institutions operate. These are the time frames they operate. So let's get right into it. First and foremost, you must first classify the PDRAs in the higher time frames accurately to assist in identifying key levels. So when you come to the chart, your first operation is to identify these key levels, these PDRAs on the higher time frames. This will be key. So here we say weekly fair value gap high, and here we have the weekly fair value gap low. Right. So when identifying these PDRAs, you will only mark out the PDRAs that you yourself can see. Right. So from everything we've been doing from episode 1 down to episode 26, it's discussing this language. And once you understand the language and understand the characteristics of the algorithm, you will these characteristics are what you will identify at the higher time frames. So what can I see here also? You can see this week. So I'll measure the week. So this is a premium week because it is currently above market, the current market price, right? So this is a premium week on the weekly. So I'm only interested in the midpoint of that week, which is the consequence encroachment. Weeks are imbalances. So every time you see a week, the algorithm sees that as a form of imbalance, especially long weeks. So here the weekly premium CE, all right? Premium because it is currently above current market price. So down to the daily time frame. So on the daily time frame, if you are using this from this swing low to this current swing high that has been formed here by yesterday's Tuesday's trading, you would want to look for the midpoint and the midpoint of it. So let's use the bodies for this and this, the highest bodies. All right. Using the highest bodies, we are currently above the equilibrium of this range, and you have this PDRA here, this BC. So you have a daily BC here. So as I said earlier, you have to identify the PDRAs that you can identify on the higher time frames first before you delve into the lower time frames when doing the top-down analysis. So here you have the daily BCI, and just below it you have the daily BC low. All right. So let's continue. And just below this equilibrium of this range, you have this fair value gap here, this BC, which is in a discount on the daily time frame. So I want to call this daily BC. All right. So when you have your PDRAs all outlined in the higher time frames, it will keep your bearing focused when you are navigating the lower time frames. And understanding top-down analysis, it is better for you as a trader to also incorporate the concept of intermarket analysis. So as we are currently charting the ES, we would use the Nasdaq, that is the US 100, for intermarket analysis because they are the mostly closely correlated assets, right? So let's go. So you want to understand, you want to see and understand what the closely correlated asset is doing on its higher time frames also, to then get your narrative clear as possible. So yeah, you have the weekly, and just below it you have the weekly fair value gap below, which is a BC, and daily to measure this, the bodies, to the body currently at equilibrium. We currently pierced equilibrium during today's trading. So you have this, daily fair value gap. The low of this BC is at a discounted point in price in respect to this range. So you call this daily discount, and just above it you have the daily. So from the daily time frame, you had this imbalance here, and price chased into it here, and then broke the imbalance here. This will make this BC now become an inversion fair value gap here. So if you go down to the lower time frame, you would want to see the lower time frames resisting, using this inversion fair value gap now as a resistance point to go to discount, to seek discounted price. So this would be a, let's let's make this color back to the ES, which is the US 500. So when you have your chart layout on the higher time frames all marked out like this, then you start going for the lower time frames. So as a scalper or an intraday trader, it's advisable to start on the 4 hour time frame. This is how me personally I do my intermarket analysis while scalping. I start with the 4 hour, but the PDRs, the key levels from the weekly and the time and the daily time frame, are must be on the chart, so they are paramount. So you have them to understand where the market is trying to likely draw to next. This is why you must outline and classify those PDRs on the higher time frames. All right. So back to this. So on Monday's trading, we had the consolidation because we are currently in a new month, which is September. So we want to outline the opening price for this month's trading. So So here we call this the step. So on the 4 hour time frame, what PDRAs can we see here? So here you have this imbalance here. Price trades down inside of this imbalance, taking out this loads here and also this loads. So we've gone to a pool of liquidity now inside of an imbalance. Now you are interested in this BC, this current BC that price is currently working inside of. So below it here you have the 4 hour BC low. So it's a CB. And just above it we have the 4 hour CBI. So we get your narrative from the higher time frames. Each higher time frame is personalized, is subjective to the current to the trader that is trading. The 15 minutes can be your higher time frame while you use the 1 minute and the seconds chart as your lower time frames. And if you are a position trader, the monthly time frame can be your higher time frames, and then your daily time frame will be your lower time frames. All right. Each time frames is personal to how you use each time frame and classify them is personal to your own trading personality and your own trading style. Either a short-term trader, a scalper, a position trader, or whatever kind of trader you are. So now we have this relative equal lows here, which price broke down, and this will be seen as a support broken, and it will be wanting to be used as a resistance level. So if we're expecting higher prices because we are currently below September's opening price, if we are expecting higher prices, we would want to see this support level not act as resistance. We want to see it violate. We want to see price violate it to the upside. So here you have this support level. So you have this support level here. So you want to see if this imbalance now on the 4 hour time frame will be an inverted, will be an inversion fair value gap. You don't want to see price support it here on the lower time frames. You want to see it act as a support and then go higher, because from narrative we are currently below the monthly open and the weekly open. And when you have price below, when you are bullish and price is below a monthly open, a weekly open, and also a daily open, this is the algorithm telling you that a significant move is coming. For a higher probability trade idea, your higher time frames and your lower time frames must be in line with each other. We want to see the lower time frames and the higher time frames are aligning itself to give you the direction that the price is trying to go to next in the higher time frame. So let's go to the lower time frames now to see the story that is being told on the higher time frames. So on the 15-minute time frame, the 15-minute time frame is the bear radar time frame. So we are currently below the equilibrium point of the 4 hour CB. So we are currently at a discounted level on the 4 hour CB. So we trade from daily PDRAs to 4 hour PDRAs, and we trade from 4 hour PDRAs to 1 hour PDRAs, like that. So it goes. So we had this back and forth price action during London's trading after midnight opening price. So this back and forth price action, this is significant that there's damages that has been done on both sides of the market, on short sellers and also long early longs. So people that took their long positions here and placed their stop loss below here, the algorithm takes them out here during London's trading, and then London makes this low here at 3 a.m. Now, if we are bullish, if the algorithm is interested in this buy side liquidity resting above here, which also coincides with this CB here. This CB, we only have the first quadrant of the CB being filled. That means it is severely lacking in buy side delivery. So if we are to come to this high now, we would want to see price stay above the midpoint of this imbalance here this week. So take your flip and indicate the midpoint of that of this week. So we want to see price stay above this level. So if price stays above this level, then we're coming here. The algorithm works in an if and then syntax. If this, then that will happen. If that, then this will happen. Like that. That is the language that the algorithm understands. The joint liquidity for this intraday trading, for this day's trading, is this 4 hour CDI, because we reacted from this daily. As you can see, price went higher here above a key level and then dropped lower, then went higher here, making this a resistance broken, turn support. So you get true support and resistance logic from key levels, not to the tick, not as retail sees support and resistance like a line that cannot be crossed. Implements the power of three concept. So here you have the midnight opening. And here you have the 8:30 opening. So during after 8:30 opening price rallied higher and left an imbalance here. And then we traded back down inside of this imbalance here. So market structure, when doing top-down analysis, you must also implement the idea of market structure. So what does market structure teaches us about an imbalance that has been balanced? So when price goes to balance an imbalance, that is termed an intermediate term low or an intermediate term high. In this case, it is an intermediate term low. So this set of down close candles that balance this imbalance here, this imbalance from the 8:30 candle, this now is an intermediate term low. You do not want to see an intermediate term low violated. When an intermediate term low is created, you do not want to see that intermediate term low to be violated. So price came down here to revisit this other block here, which is the intermediate term low, and then rallied higher. So we are currently trying to facilitate the second stage distribution of a market maker buy model. Say this is the short-term drawn liquidity, then here, then you have this consolidation here, and also this volume imbalance here. So, but we'll see. So this is how you implement the idea of top-down analysis into your trading from higher time frames down to the lower time frames. So let's look for the factor nature of this model on this time frame here. So as you can see, we have just weeks coming to the midpoint of this of that 15-minute week. We do not want to see any price action, anybody close of any candles below the week, below the midpoint of that week, because that week now it's that week should act as a support level to take price higher to this buy side liquidity here and also this 4-hour CBI. So you want to see this other block now act as a support level to take price up to this buy side liquidity, which is resting here, and also this down up to this 4 hours CB high. Why is this? Why is this setup seen as a valid setup? It is because it is at a time in which the market maker, which a second stage distribution of a market maker model takes place. That sorry, a second stage reaccumulation of a market maker model. So we are currently acting with the second stage reaccumulation of this market maker model. So the midpoint of this year is this. So here you have the mean threshold. So you want to see all of this here act as a support level, taking price higher for higher prices. As you can see, the plot twist is being done on the lower time frames, while the narrative on the higher time frames is being kept intact. See how price is reacting at this weekly fair value gap high. This is price engineering liquidity, engineering buy stops So traders that are not seeing price like this with this lens that we are using currently, they will place their buy stops here, which is above, which is just right below here, and they are already resting buy stops above here. So price will react and penetrate to this buy side liquidity up to this 4-hour CD high here. So you have price here using the midpoint of this week here as a support level to then rally higher. So we've tapped buy side liquidity now resting here, which is the buy side from the 15-minute time frame. So we've pierced it here, and we're interested in at least 2 pips to 2 handles to 3 handles above the buy side liquidity, which is just above this, which is just at this 4-hour CB high. We currently have a high resistance liquidity run like this because of yesterday's trading. Yesterday's trading was a one-sided. We had one-sidedness in price like this. So you see, yesterday price was just falling. So a when you have the previous day's trading just falling like this, the next day's trading, the morning session of the consequent day's trading, you expect resistance in price like this. You expect a high resistance liquidity one like this in price action. So this is the reason why we have back and forth price action like this for this session. So I just choose to use this live trading to illustrate the idea of top-down analysis. How we use the PDRAs from the higher time frames to accurately describe the storyline that goes on in the lower time frame, because the lower time frames are where this manipulation takes place. The manipulation and the revealing how the algorithm reveal its hand. It does that in the lower time frames, but the higher time frames are paramount to these lower time frames. The bulk of the story, the bulk of the volumes and everything in relation to trading is more focused on the higher time frames, and thus making the lower time frames subordinate to these higher time frames. So this buy side liquidity now is from the 15-minute time frame here. So we've traded inside of this buy side liquidity here, which corresponds with this imbalance here. So we are currently balancing this imbalance while pairing up liquidity. What liquidity? Liquidity that has been taken from this sell side liquidity here below this low. When this low was created here, price dropped lower here, and then you had this back and forth price action like this, and then price rallied higher. So this is it. This on its own is a trading model. So if you've studied well enough, you would have seen these characteristics in price action. When you have this low taken like this, traders will be long here. Traders that are long here, they will place their stop loss at this low or below it. When the market is falling like this, during this time, the your broker will increase the spread. So it doesn't matter how low you put your stop loss here. Even though your stop loss is like 200 below here, your broker will increase the spread during this session, during these Q zones. This is another reason why you are advised to trade within the Q zone so that you can see the manipulation taking place. You see how the algorithm books price and then takes out liquidity at both sides of the market so that both traders won't be profitable. So the early longs, they were taken out here, and the shorts here, they would be taken out because we are currently bullish for the morning session. So it doesn't matter if their stop loss is placed here or at this liquidity pool or at this buy side liquidity, they will be taken out. And understanding how top down analysis help you to frame your to have a framework when dealing in your lower time frames to trade and navigate those lower time frames. This is the business. All right. So I'll talk to you in the next video, and have a nice day and goodbye.